Good evening and a warm welcome to you and your money. I'm Bryan, and this evening we are focusing on the investment world. January really was an unusually eventful month, marked by a series of significant market movement developments. The month began with concerns that interest rates might not decline as much as anticipated, fueling initial negatively. Just a few days later, inflation figures came out as better than expected, lifting market sentiment, driving a rally. Then Donald Trump's election, coupled with the launch of DeepSeek's China's latest AI breakthrough, sparked disruption and heightened volatility, particularly in AI-related stocks. Markets remained unsettled as Trump's tariffs announcements, followed by partial backtracking, added to the uncertainty. Despite this, January ended on a surprisingly positive note. February has already seen continued market fluctuations, and today's disappointing US jobs data dampened investor. That was Friday. And then reading further, decline across the major indices. Amongst the biggest losers was Amazon, one of the Magnificent Seven stocks, which went down 4.1% after issuing lower than expected Q1 earnings and revenue forecasts. So one doesn't really understand, exactly getting weakness in cloud computing division. And joining this evening from the Zoom room in Cape Town is Henry Biddlecombe, investment analyst from Anchor Capital. Henry, good evening. Lovely to have you on the show. I must tell you, Henry, I was in Cape Town yesterday on Clifton Beach. As hot as the weather was, I can't believe how cold those waters are. But I'm sure you can tolerate. I know you need a wetsuit down there. Question, Henry, in the stock market, investors are increasingly concerned about very much about what is expected, what is happening, and the start to the year, the markets may have been up in February, but certainly investors have taken a concern. There's a lot now, I think, more sitting on the sidelines saying, where is this market going? What's going to happen to the market? Really interested in your thoughts.
Yeah, Bryan, I mean, you and I have been talking about the market for the better part of a year now, where I've said to you, things look a little expensive. I still think they look expensive. If you look at the forward multiple on the S&P 500, sitting at around 22, relative to a long-term average of around 17. And that's with consensus earnings growth expectations at 14% for this year and 12% next year. So the market's relatively expensive on elevated earnings growth forecasts. And for me, that's never really a great setup. So, I expect equity returns from here to be quite muted.
Henry, when you say quite muted, do you think investors have unrealistic expectations for this year?
Well, it's whether or not they're unrealistic, I suppose, remains to be seen. But what I can say is that a fairly good or strong scenario is priced in. So the news would have to be better than good for equities to have a really strong year. And if the news isn't good, if it's fair to bad, then there's downside to equities.
Henry, when you say the news, we're talking about, board of directors comes out, they've got objectives, they've done the analysis, they're very happy with their results. And they come out, they have a drink, they pat each other on the back, and then the analysts get hold of it. So when you say not happy, is it all based on what the analysts expect from a company rather than when a company issues good results and is happy with that performance?
100%. So really all a market is a set of expectations that get priced into risk assets, right? And those prices or the market moves around when the reality is mismatched from those expectations. So what I can make an assessment of is where expectations currently sit, and I think they're lofty. So that's why I say there isn't much room for disappointment from a corporate earnings perspective.
Yeah, and there's always the view of when do you get into the market, and people always say weaker investment sentiment is often a potential tailwind, but there are bullish and bearish sectors. Henry, just deal with bearish and bullish. What is bearish about this market? What is bullish about it?
So, okay, I guess the bearish take is that the market's expensive, it's fully priced. even against earnings, and earnings forecasts are elevated. So it's expensive on elevated forecasts, which is never a great setup. I guess the bullish case is that you've got a pretty pro-growth administration coming into the US who seem determined to get the fiscal situation under control. They seem willing to let inflation run hotter for longer, which is good for nominal growth. So that's not necessarily a bad setup for equities. So you've got valuation and earnings growth expectations kind of as a concern. But then on the other end of it, you've got a government which seems determined to let the economy grow in nominal terms, regardless of the impact on inflation. So it's a little bit of an offset. I guess what I'm saying is, Brian, if there's a dip, I'm buying it.
When you say when there's a dip, explain dip.
Around about a 10% correction. Anything less than that's noise.
Yeah, and then Henry, what about the Magnificent Seven? I know that changes a little bit. One stock comes in. I think last week Broadcom came in, and Tesla may have dropped out. But is that because if you look at the Nasdaq and you look at the S&P, both of those indexes are driven by those top stocks. It may be a bit more than the 7. It may be 12 or 15. And if one of them report badly, I mean, we saw 2 weeks ago, 3 weeks ago, NVIDIA come off enormously. I think 18% in the one day. It bounced back 9%, and then over the next few days, it retraced back to where it's touching its levels low. I mean, are those the stocks you're looking at, or is there a wider range of stocks that you can now actually choose from for the first time in quite a few years?
So I think the opposite is true. Going back a year, I think the Mag 7 were pretty fully priced, and the rest of the market looked arguably relatively attractive. But even those valuations have picked up. So now there isn't anything that's obviously really cheap to me. There's huge concentration in the market. Obviously, it's something we've covered at length previously. I mean, 40% of the S&P 500 is made up by a handful of companies, some of which you've mentioned. In the event of a downturn, those stocks probably fall more than the rest of the market, but the rest of the market will fall. It can't defy gravity. So you could insulate yourself by buying something like the S&P 500 equal weighted index, where you have less exposure to those Mag 7 names. And perhaps that's not a bad way to allocate your equity exposure now.
Henry, that's interesting. I've never heard that term before, called equally weighted. I didn't realize that there was such an index. I mean, you know that if you're buying into the S&P or NASDAQ, the largest company is going to be the greatest percentage of that money that you've invested. Are you talking about equally weighted, similar to our SWIX?
So basically, instead of it being market cap weighted, it's just divided by the number of constituents in the index, so that you get more exposure to this, much more exposure to the smaller companies and much less exposure to the bigger companies. I mean, that's really the point to make.
But in a pro rata basis.
Yeah.
But then you're going to have hardly any exposure to what we call the Magnificent Seven.
Well, there you go. So that would be the objective of that index. So you've got more exposure to the smaller stocks, less exposure to the bigger stocks. And you've got to take a view on whether or not that's the right strategy at this point in time. And I don't think it's a bad one.
Yeah. Henry, let's talk a bit about interest rates. Last week, interest rates in the USA remained unchanged. In South Africa, they dropped 0.25%. Are there some opportunities for global investors to buy rising bond yields? And how do these yields impact where there is a stronger or weaker dollar?
So I think what the viewer is asking is, are bonds attractive now? I think globally and locally, yes. I think your total return expectations on bonds relative to equities at this point are pretty attractive. To put it in layman's terms, if I think that the equity market's going to give you 4 or 5% a year for the next 3 years, and I can buy a treasury that gives me that with a 100% level of certainty, why on earth would I opt for the risk of equities when I could just park my cash in a bond? So I think this is a good time to be accumulating bonds, both offshore and locally. How does the strength of the dollar impact local bonds? Well, typically, when the rand strengthens, our bond yields strengthen, and vice versa. So if you can tell me where that currency pair is going to go, I can tell you what bond yields will probably do. But that's a fool's errand.
But Henry, yield on bonds is just not based on interest rates. There's security and of that bond. I mean, that can have an impact on bond rates.
Yeah, so I mean, it's bond yields on bonds are a function of many different factors. One of which is a kind of the risk-free rate. But you've got risk premiums, you've got geopolitical risk premiums, government risk premiums. Um, so it's all about uh, the market's appetite for risk and interest rate expectations at the end of the day.
Yeah. Henry, let's talk about a lot of people are saying, and I must tell you, I was absolutely amazed. I don't often read the full Sunday Times, but as I was flying back last night, I've never seen so many articles written by so many different people about the Trump story and what's happening. So let me ask you this question. In terms of Trump's exposure and what's happening, many South Africans are now saying, I don't want to buy bonds because I don't know what Trump's going to do and what America's going to do in South Africa. But I've always said to them, banks don't bail out governments. It's governments that bail out bonds. What do you think? Do you see a risk in government bonds going into traditional government treasuries, government bonds?
Are you talking in America or are you
In
talking
South
now?
Africa, in South Africa.
In South Africa? Yeah, I don't think Trump really has much to do with the credit risk of the South African government at this point. Um, what is important is our fiscal situation and our ability to manage it going forward. Are we in a better place now than we were a couple of years back? Absolutely. Um, do our bonds screen cheaply on a global stage? Yeah, probably. So I don't think Trump really factors into your decision in on investing into South African bonds.
Okay, we're going to go take an ad break. I've got one more question to ask you about our interest rates, and then we'll get on to emails. Stay tuned. You're watching You and Your Money. We'll be back shortly.